Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at multi-sensor AI.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there are any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
All right, so this one's interesting. Multi-sensor AI. It feels like they're at a real turning point.
They absolutely are. The core of this story is a huge strategic pivot. They're moving away from just selling hardware, standalone boxes.
Right, and they're trying to become this high-margin software as a service company.
Exactly, a recurring revenue model. And that shift, well, it explains almost everything we're seeing in their financials right now.
And it looks a bit messy on the surface. That pivot is clearly expensive. You see it right in the top-line revenue.
You do.
I mean, you look at Q2 2025, revenue is down, 33% year over year?
It was, down from about 2.1 million. And that's the cost of transformation. It's the kind of headline number that can scare people off if they don't look any deeper.
But if you do look deeper, that's where the other story is, the software revenue, the part they're actually trying to grow.
That's the key. That specific segment is flourishing. It was up 37% year over year in that same quarter.
So it's working. The strategy is showing traction where it really counts.
It is. And we're seeing things stabilize a bit. Q3 revenue, for instance, came in sequentially higher at 1.57 million. So it looks like they might be building a floor.
Okay, but this is the part that really caught my eye, the gross margin.
Yes, it's incredibly strong.
Despite the revenue dip, despite getting rid of lower margin hardware sales, their gross margin is holding steady at 60.7%.
60.7. That's not a hardware number. That's a software number. It tells you their pricing power is real and the value is in their IP, not just the equipment.
And the potential for leverage there is huge if they can keep that margin while growing the software side.
Every new dollar of revenue could have a massive impact on profit down the road.
Okay, so that's the bull case. The growth, the margins. But let's be real about the downside.
Yeah.
This company is not profitable.
Not even close yet, and we have to be clear about that. The net loss in Q2 was about $3.3 million.
And the bigger number, that accumulated deficit, it's over $64 million. That is a huge hole to climb out of.
It's a massive weight, no question. It means you have to have absolute faith in management's execution.
But countering that risk, you have the balance sheet, which, despite the losses, looks surprisingly stable.
It's rock solid, and that's what gives them the runway to actually make this pivot work. Total assets of around 14.6 million versus liabilities of just 4.8 million.
Their current ratio is 2.0, so they have twice the current assets needed to cover their short-term bills.
And almost no debt. The debt to equity is basically zero. They built themselves a safety net.
Which brings us to the next big chapter in this story, the capital raises, the war chest. Exactly. They knew they needed more runway, and they went out and got it aggressively. In Q4 2025, they pulled in over $27 million in gross proceeds.
More than doubling their cash position.
And these weren't simple raises. The first one was a $14 million private placement.
Right, and the key detail there is that a big chunk of it, 11.15 million, is stuck in escrow.
Stuck pending a stockholder vote. That approval is crucial for them to get that last bit of capital to pour into the SaaS expansion.
Then came the second event, a registered direct offering. That brought in another 13.6 million in net proceeds.
And we saw some interesting insider signals around that time. 325 capital entities were buying in October, which is a pretty strong vote of confidence.
It is. But all this cash, it doesn't come for free, does it?
No, it definitely doesn't. And that leads to the other side of the coin for investors.
A dilution.
A substantial amount of it. To raise that 27 million, you're looking at over 20 million new shares and warrants combined.
And those warrants, they just hang over the stock. If the price goes up and they get exercised, existing shareholders see their piece of the pie get smaller.
It's a classic warrant overhang, something you just have to factor in. But this cash, it solves a more immediate, almost existential problem.
You're talking about NASDAQ.
The NASDAQ clock is ticking. Delisting is a real risk that could just destroy value no matter how good the tech is.
Absolutely. They have until May 11th, 2026. To keep that stock price over $1.
So every new contract, every earnings beat, it's all part of the mission to stay above that $1 mark. Failure means going to the OTC markets, and that's not good for anyone.
Which brings us back to the tech itself. What is the actual competitive advantage here? What's their moat?
Right, because predictive maintenance is a crowded space. What makes them so special?
It's their multi-sensor approach. They aren't just looking at one thing. They combine thermal, acoustic, and vibration data.
So they're building a more complete picture of a machine's health.
A much more complete picture. It lets them catch problems that a single sensor system would totally miss. But the real game changer
Is that it's hardware agnostic.
Exactly. They don't care who made the pump or the motor. Their software can sit on top of almost anything.
Which makes it so much easier for a new customer to adopt. You don't have to rip and replace all your existing gear.
And their value proposition is crystal clear. They can cut customer downtime by 20 to 30%. In heavy industry, that's a catastrophic amount of money saved.
And it's not just a theory. We're seeing them land some really big marquee customers.
We are. The big one everyone is watching is the deployment at Manchester Airport.
A huge high-profile win. That's expected to go live in Q1 2026.
If they nail that one, it becomes a massive reference case for them globally.
Plus, they've already secured a partnership with a global distributor to expand in the U.S. logistics market.
So the pieces are falling into place.
So what should people be watching for, say, in the next 3 months?
The calendar is packed. First, that shareholder vote for the escrow money. That's happening very soon.
An approval there just accelerates everything.
Then you have the Q3 earnings release in December. That's the first real chance to see if that software growth is still accelerating.
And then Q4 earnings in February, which gives us the full picture heading into that critical period for the NASDAQ deadline.
Exactly.
Now, if we look at the chart, the stock itself, it's been volatile, but it feels like it's building a base.
It does. We saw that huge 23% pop in one day back in October. Since then, it's been making higher lows right around that 1.41 support level.
And it's holding above its 50-day moving average, which is a good sign for short-term momentum.
The RSI has cooled off a bit, which is healthy. And interestingly, the stock RSI indicator hit a deeply oversold level recently, which often sets the stage for a reversal if some good news comes along.
So the technicals are coiled, ready for a catalyst,
Uh-huh.
and the sentiment, it seems really high right now.
Analyst sentiment is definitely bullish. They're all pointing to the funding and the big contract wins. We're seeing price targets anywhere from $2.25 up to $3.
Which is a lot of potential upside from here. But that kind of sentiment also creates pressure.
Immense pressure,
Right.
especially on the short sellers.
Let's talk about the shorts, because the short interest is, wow, it's high.
It's extremely high, around 30.8% of the float. That means nearly a third of the available shares are betting on the company to fail.
That's a dangerous game to play if the company starts delivering. You've basically got a huge pool of forced buyers waiting in the wings.
That is the classic short squeeze setup. A great earnings report, a new partnership, anything positive could trigger a very rapid, very violent move up as they all rush to cover.
And speaking of partnerships, there's a lot of chatter about that, isn't there?
A lot of speculation, yeah. Rumors about strategic partnerships with major SaaS providers, even some M&A chatter.
That's all speculative, of course.
Purely. But it shows you how the market is starting to perceive the value of their technology. If they execute on Manchester, those rumors get a lot more believable.
So, to sum it all up, you have a company at this critical inflection point. They've got a big deficit, but they also have fresh cash, a strong balance sheet, and tech that seems to be truly differentiated.
That's it in a nutshell. Success really hinges on two things: management's ability to execute and grow that SaaS revenue, and navigating that NASDAQ compliance window through May 2026. That's the timeline.
So the provocative thought here, what's the big picture risk reward that people should be thinking about?
I think the most interesting scenario is this. What's the true value of that hardware-agnostic AI if they prove it works at scale? If they really can cut downtime by 30% for giants like Manchester Airport? What's the price tag when a Siemens or a Honeywell comes knocking? Is this actually an acquisition target in the making? That's the big question.
Something to think about.
Make sure you subscribe to Smart Wealth with Joshua so you don't miss our next analysis into the markets.